Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine for a second that you're tasked with building like the ultimate multi-billion-dollar AI supercomputer.
Okay, setting the stage. I like it.
Right. You spend years perfecting the neural networks, you're stacking the most advanced silicon on the planet, designing all these intricate cooling systems, and then right before you flip the switch, you realize you completely forgot to map out where the electricity is actually going to come from.
Which sounds like a joke, but it's really not.
It's not a hypothetical at all. That is the exact reality facing big tech and the generative AI industry right now. These hyperscalers are building massive digital superbrains, but they're rapidly colliding with this massive structural energy bottleneck.
Yeah, they really are.
So today's deep dive is for you, the listener, and we are looking at this giant stack of research you sent us on a company that's attempting to completely solve that bottleneck. And that company is Oklo.
Yeah, and honestly, it is a phenomenal moment to be looking at this space because the intersection of artificial intelligence and physical energy infrastructure, it's rapidly becoming the defining investment theme of the 2020s.
Absolutely.
The market is finally waking up to the math. I mean, you can hoard all the GPUs in the world, right? But if you cannot plug them into a reliable 24/7 carbon-free baseload power source, the entire AI growth narrative it hits a brick wall.
Because you can't run a data center on like a breezy day.
Exactly. Intermittent power like solar or wind just cannot run a massive data center cluster. They need firm power, constant power.
Okay, let's unpack this, because looking at the stack of financials we have on Oklo right now, there is a massive contradiction just staring us in the face.
The revenue numbers.
Yeah, it's what I call the pre-revenue paradox. This company is making $0 in fiscal years 2024 and 2025. Absolute zero.
Oh, not a cent.
In fact, they just reported a recent earnings miss. They posted an earnings per share of negative 27 cents, which missed the Wall Street estimate of negative 17 cents by a full dime.
Which is a pretty wide miss, honestly.
It is. So, to use an analogy, investing in Oklo right now feels a bit like trying to build this futuristic national network of gas stations before the new generation of cars even exist on the highway.
That's actually a great way to put it.
So how exactly is a company with zero current revenue securing multi-billion-dollar revenue visibility for the end of this decade? It doesn't make sense.
Well, to understand that paradox, you really have to look at the sheer desperation on the demand side. The reason Oklo has that kind of future revenue visibility is their 14-gigawatt customer pipeline.
14 gigawatts, that's huge.
It's staggering. And when you actually break down that pipeline, the scale becomes even more clear. We're looking at a landmark 12-gigawatt deal with Switch.
The massive data center operator.
Exactly. And on top of that, a 1.2-gigawatt agreement with Meta. I mean, these are not speculative back-of-the-napkin handshakes here.
Right, these are serious players.
The biggest data infrastructure operators in the world. And they're signaling that they desperately need what Oklo is building, and they need it locked in before anyone else gets their hands on it.
But what they're building isn't just, a traditional nuclear plant.
No, not at all.
Because if we look at traditional nuclear, those projects take over a decade, billions of dollars, and just endless regulatory headaches to even break ground. Oklo is doing something fundamentally different with their tech, right?
Yeah, completely different paradigm.
They're using fast neutron fission and liquid metal cooling. Now, we are not all nuclear physicists here, so how exactly does this technology create a moat for them?
What's fascinating here is the mechanics of it, because this is where the entire thesis lives or dies. So in a traditional commercial nuclear reactor, they use water to cool the core.
Right.
And the water also acts as a moderator, which physically slows down the neutrons. But because those neutrons are moving slowly, they only harness a tiny fraction of the potential energy in the uranium fuel.
Okay, so it's inefficient.
Highly inefficient. That leaves behind a massive amount of highly radioactive, long-lived waste. But Oklo's fast-fission technology flips that script entirely. They don't slow the neutrons down. They let them move incredibly fast.
And what does a fast-moving neutron actually do differently, like in practical terms?
It carries enough energy to split those tough, heavy isotopes that traditional reactors just leave behind as garbage.
Oh, wow.
Yeah. Oklo's Aurora microreactors are specifically designed to actually consume the spent nuclear fuel from traditional reactors.
Wait, really? So they are essentially running on recycled nuclear waste?
Exactly. They are eating the industry's garbage and turning it into electricity for AI data centers.
That is wild.
And the geopolitical implications of that are massive, too. I mean, if you look at Oklo's competitors, companies like NuScale or Nano Nuclear Energy, they are heavily reliant on a global supply chain for enriched uranium,
Right, getting raw materials.
specifically a type called high-assay low-enriched uranium, or HALEU. And that supply chain is incredibly strained right now. Plus, historically, it's heavily tied up with Russian state-owned entities.
Which is a massive risk factor right now.
Massive. So by recycling domestic waste into fuel, Oklo is totally vertically integrated. They completely bypass that entire global supply chain scramble.
Okay, so that solves the fuel problem, which is huge. But what about the liquid metal cooling part? Why does it matter what fluid is running through the pipes?
Well, it matters a lot for scale and location. See, traditional water-cooled plants require these immense high-pressure systems, so the water doesn't just boil off into steam.
Right, you need pressure to keep it liquid.
Exactly. And managing that pressure requires those massive multi-billion-dollar concrete containment domes you picture when you think of a typical nuclear plant. But liquid metal doesn't boil easily. It operates at normal atmospheric pressure.
Oh, I see. So you don't need the giant dome.
You don't need a giant pressure vessel at all. The footprint becomes incredibly small, which allows Oklo to factory build these microreactors rather than doing these massive bespoke construction projects on site.
So the end game here is geographic freedom. You don't have to build a giant power plant in the middle of nowhere and then run like hundreds of miles of transmission lines to a data center.
Precisely. You essentially drop this factory-built microreactor right next to the data center.
It's almost like the cloud computing model. I
Yeah.
mean, hyperscalers don't want to build their own power plants any more than they want to build their own internet service providers.
Guys, they just want to plug in and go.
So Oklo handles all the complex nuclear physics, and the data center just subscribes to the power. Utility as a service.
That is the exact business model. But, and you highlighted the core friction point earlier, that level of vertical integration, designing custom microreactors, building advanced fuel recycling facilities, navigating the Nuclear Regulatory Commission, it is insanely capital intensive.
Which brings us to the most glaring risk on the financials.
Right.
The cash burn. I mean, we talked about the earnings miss, but the operating losses are widening aggressively.
Yeah, they are.
They went from losing $52.8 million to losing $139.3 million in fiscal year 2025.
It's a huge jump.
They are ramping up staffing, they're pushing project development, and management is explicitly guiding for a colossal capital spend. We're talking $350 million to $450 million in 2026 alone, just for facility and plant construction.
Right.
So if I'm an investor looking at a pre-revenue company planning to torch $450 million in a single year, my immediate assumption is that they are about to dilute their shareholders into oblivion to pay for it. I mean, how do they survive this?
Well, it's a valid fear. It is the graveyard of so many early-stage infrastructure developers. They design a great product, run out of cash, and dilute their early investors down to pennies.
Exactly.
But Oklo possesses what analysts are calling a fortress balance sheet, and it fundamentally separates them from the pack. They ended fiscal year 2025 with an estimated $1.4 billion to $2.6 billion in liquidity.
Wait, let me stop you there. $1.4 to $2.6 billion in liquid cash.
Yep.
For a company generating $0 in revenue, that is an absurd cushion. What do their liabilities look like?
This is the crazy part. Their total liabilities sit at a minimal $52.2 million.
$52 million. So they have virtually no debt dragging them down.
Basically none. If you run the liquidity math, it results in an ultra-defensive current ratio of over 49.
Over 49. Wow. Just to give you, the listener, some context on that metric, the current ratio measures a company's ability to pay off its short-term liabilities with its short-term assets.
Exactly.
A current ratio of 1 means you are basically just breaking even. A ratio of 2 or 3 is generally considered very healthy in the corporate world.
Definitely.
A current ratio of 49 means that for every single dollar of short-term debt Oklo owes, they have $49 in highly liquid assets ready to cover it. That's insane.
It is.
Yeah.
And it completely recontextualizes that intimidating 2026 capital spend we were just talking about. Yes, they plan to deploy up to $450 million, but that robust cash position easily covers the runway.
They can just pay for it out of pocket, essentially.
Exactly. Those funds are being poured directly into the Aurora power plant pipeline and building out those fuel recycling facilities.
Yeah.
Because of the fortress balance sheet, they do not need a near-term dilutive capital raise to keep the lights on or pay their engineers.
That is a massive de-risking factor. You don't have to worry about checking your portfolio tomorrow and finding out the company just issued, like, millions of new shares.
Right, which is a huge relief for investors.
And clearly, the broader market is pricing in this reality right now. We are seeing classic high beta momentum price action on the charts.
Oh, the chart is wild right now.
For those tracking it, high beta means the stock is significantly more volatile and reactive than the broader market, and momentum means the trend is violently upward. The stock ripped from the mid-40s back in late March to a recent intraday high of $80.64.
Nearly a double.
It's currently trading well above its 50-day moving average, which sits at $59.08, and it's creeping right up on that major psychological resistance level, the 200-day moving average at $87.04.
The technical setup shows a massive structural repricing of the company. The market is waking up.
It does, but I am going to push back here and play the skeptic for a minute.
Bring it on.
Because the chart looks great, right?
Right.
But if you dig into the SEC filings, the executives are actually selling into this rally. The CFO, Richard Bielmeier, just sold over 72,000 shares, and the CEO, Jacob DeWitt, dumped 140,000 shares.
Right, the insider sales.
Now, I know the standard Wall Street line is that this is just routine profit-taking, but selling hundreds of thousands of shares right as you are asking public investors to hold the bag for a multi-year commercialization phase, that feels like a massive red flag. Why sell now if the 14-gigawatt pipeline is such a sure thing?
It's a fair point, but you have to remember that executives have personal balance sheets too. You have to evaluate insider selling through the lens of proportion.
Okay, proportion. What do you mean?
Well, when a stock violently re-rates from the mid-40s to the 80s, taking some chips off the table is just standard wealth management. The key metric isn't what they sold, it's what they retained.
So what are they still holding?
Even after that sale, CEO Jacob DeWitt still holds roughly 739,000 shares. The CFO still holds around 386,000 shares.
Okay, so they still have a massive chunk of skin in the game.
Exactly. They are still massively levered to the upside of this company. If we connect this to the bigger picture, if you are looking for where the true conviction lies in this market, insider sales like this are just noise. You have to look at the institutional flow.
The big money.
Right. Retail investors might get spooked by an insider filing, but the heaviest hitters on Wall Street are currently stampeding into this stock.
The institutional accumulation numbers in our notes are honestly hard to believe. Let me just run through these.
Go for it. They're staggering.
Okay, Vanguard Group increased their holdings by 33.4%. State Street is up an eye-watering 454.5%.
450%.
Mirae Asset increased their position by 71.8%. When you tally it all up, total institutional ownership of Oklo is now sitting at 85.03%.
85%.
Stop and think about that. 85% of a pre-revenue, highly speculative nuclear startup is owned by the smartest, most risk-averse institutional money in the world. That does not happen by accident.
It doesn't. And the trading volume proves it is sustained accumulation. We've seen trading volume expand by 185% recently, hitting 31.5 million shares.
Well, that's a lot of volume.
When you see massive volume expansion on up days, it validates the strength of the breakout. It tells you this isn't just retail day traders playing momentum games. This is institutional capital taking heavy long-term positions.
And the options market is backing this up too, right?
Aggressively. We are looking at a notably bullish put-call ratio of 0.56.
For those unfamiliar with the put-call ratio, it's a gauge of market sentiment. A put is a bet the stock will go down. A call is a bet it will go up.
Exactly.
So a ratio of 1 means sentiment is evenly split. A ratio of 0.56 means there are nearly twice as many bets that Oklo's price will keep surging compared to bets it will fall. But here's where it gets really interesting.
Okay, where?
Institutions don't just wake up one morning and decide to buy millions of shares of a pre-revenue nuclear company unless external reality forces their hand. They need a catalyst. They need validation.
Right, some kind of proof.
And Oklo just handed them the ultimate validation, a formally announced collaboration with Nvidia and the Los Alamos National Laboratory for AI-enabled research and development.
That partnership is the skeleton key to understanding the institutional stampede. I mean, Nvidia is the undisputed king of the current AI boom. They produce the very chips that are causing this massive energy bottleneck in the first place.
Exactly. They're the ones driving the power demand.
So Nvidia has a vested existential interest in making sure baseload power generation catches up to their computing power. If data centers can't get power, they stop buying Nvidia chips. It's that simple.
So by teaming up with Oklo,
By formally collaborating with Oklo and a prestigious, historically significant institution like Los Alamos, Nvidia is effectively blessing Oklo's technology roadmap. They are broadcasting to the entire market that fast-fission technology is a viable, serious answer to the AI energy crisis.
and the Wall Street analysts are aggressively falling in line behind that signal. We are seeing HSBC initiate coverage with a buy rating and a $96 price target. H.C. Wainwright reiterated their buy rating with a $90 target.
Even Wedbush got in on it.
Yeah, Wedbush trimmed their target slightly, but still reiterated an outperform rating with a $110 target. So we're looking at a consensus Wall Street target hovering right around that $85 mark.
Which is significant upside from the historical average.
But markets are forward-looking mechanisms, right? The Nvidia news is out, it's priced in. What exactly are these institutions waiting for next? What does the catalyst calendar look like over the next few quarters?
Well, there are three distinct catalysts on the horizon that could act as major inflection points.
Okay, what's the first one?
First, we have the upcoming earnings report in late May or early June. Now, the consensus is expecting an EPS of -16 cents. But honestly, the market will likely ignore the bottom line completely.
Because it's a pre-revenue company.
Exactly. The entire focus of that earnings call will be pipeline updates. Investors want concrete progress reports on the Switch and Meta deals, and they are hunting for announcements of new hyperscaler agreements.
Makes sense. And the second catalyst?
Second, Oklo is scheduled to present at Intercom Denver 2026. They will be pitching that 14-gigawatt pipeline and their closed-loop fuel recycling narrative directly to over 1,000 institutional investors. That kind of exposure can easily drive further accumulation.
Getting in front of 1,000 big money players is huge. And the third catalyst, the one that could fundamentally alter the timeline.
The third is speculative but highly impactful, the regulatory wildcard. There's persistent market chatter regarding accelerated licensing from the Department of Energy.
Oh, so speed up the red tape?
Right. If the DOE accelerates pilot licensing timelines ahead of Oklo's planned 2026 criticality test, it dramatically pulls forward their entire commercialization timeline. And when you pair that regulatory optimism with ongoing M&A chatter...
Oh, like someone buying them out.
Yeah, the idea that a mega-cap tech company or a major utility might just outright acquire Oklo to secure proprietary nuclear capacity. When you combine those, you have a very potent mix of near-term upside triggers.
So what does this all mean? We have spent the last 15 minutes or so detailing the massive structural demand, the billion-dollar fortress balance sheet, the institutional stampede, and the Nvidia validation.
That's a strong case.
But every sound wealth-building strategy requires a sober, cold look at the downside. And we really cannot ignore the extreme premium valuation the market has slapped on this company. Oklo is currently trading at a price-to-book ratio of between 8.3 and 10.9 times.
Which is astronomical for a traditional utility or energy company.
Exactly. I mean, value investors usually look for a price-to-book ratio closer to 1 or 2. Paying 10 times the book value of a company's actual assets means you are paying a massive premium purely for future growth. Add to that a price-to-earnings ratio of negative 106.07.
Yeah, the multiples are stretched.
When a stock is priced for absolute perfection like this, it becomes incredibly brittle. It's highly sensitive to any missed milestones, any testing failures, or any regulatory delays. It's a high-wire act without a net.
It is essential to internalize that bear case. Analysts at UBS have actually specifically flagged these execution and regulatory risks.
What are they most worried about?
Well, Oklo is currently transitioning from being a brilliant design and concept company to an execution-heavy construction company. The operational risk of construction delays and cost overruns increases exponentially during this phase.
Bending metal is harder than drawing blueprints.
Exactly. Building nuclear facilities, even small, factory-built microreactors, is historically fraught with red tape, supply chain hiccups, and endless delays. The graveyard of infrastructure startups is full of companies that had elegant designs but couldn't actually bend the metal and pour the concrete on time or on budget.
So the multi-billion-dollar question becomes, how does Oklo mitigate that existential execution risk? If they stumble, does the whole thing collapse?
This raises an important question, but it brings us right back full circle to the balance sheet. That $1.4 billion plus liquidity fortress is their primary mitigation strategy.
Ah, the shock absorber.
Exactly. It provides a massive financial shock absorber. If a facility build-out goes over budget, or if the Nuclear Regulatory Commission demands an extra year of testing, Oklo has the cash to absorb the delay without going bankrupt or diluting shareholders.
That is a huge luxury in this sector.
It is. Furthermore, they are currently participating in 4 separate Department of Energy pilot programs. By working hand in glove with the regulators from day one, rather than fighting them, they are actively de-risking the regulatory pathway to commercialization.
Which leads us to the final investment thesis. Based on the mountain of sources we've analyzed today, the physics of the tech, the fortress financials, and the macro AI environment, we are looking at an 8 out of 10 bullish score for Oklo.
8 out of 10. That's a strong conviction.
The overarching elevator pitch is this. Oklo offers asymmetric upside as a vertically integrated, pure-play solution to the single biggest bottleneck in the technology sector today. They control their own fuel lifecycle, they have a massive 14-gigawatt customer pipeline, and they have the cash to survive the build-out.
Yeah.
But, and this is the critical caveat you must remember, this is a multi-year hold. This is not a quick high beta trade for next week. You have to have the patience to hold through the 2026 and 2027 commercialization and criticality testing phases. You are waiting for that utility-as-a-service revenue model to finally materialize.
It requires immense patience, for sure. But the structural tailwinds here are unlike anything we have seen in the energy sector in decades. The sheer desperation of the AI industry for firm, clean power is completely overriding traditional valuation metrics.
And that brings us to a final provocative thought for you to mull over as we wrap up today's deep dive. If the largest, most sophisticated technology companies in the world are so utterly desperate for carbon-free baseload power that they are willing to ignore traditional valuation metrics entirely just to partner with a pre-revenue nuclear startup.
Yeah.
What exactly happens to the global energy market when these microreactors actually start turning on?
Okay.
When the geographical restraints of power generation disappear and the gas stations for the ultimate AI supercomputers finally open their doors for business, how does that reshape the physical landscape of the internet? Thank you for joining the conversation today. Keep questioning the consensus, keep exploring the mechanics behind the hype, and we will catch you on the next deep dive.